A falling inflation rate, the steady decline of prices of gasoline at the pump, and the Philippine peso climbing out of the depths of the dark has kept interest rates intact and GDP growth on track to reach or even exceed targets, all of which bodes well for the nation's top banker to hint of better GDP numbers and a robust economy in fighting shape despite a slowdown in the global economy and amidst this fear and trembling on a worsening state of trade between the superpowers. PTV's Naomi Tiburcio explains.
The central bank slightly tapered off their inflation forecast for years 2019 till 2020 after the latest monetary policy meeting. From 2.9%, this was reduced to 2.7% this year, while the 3.1% forecast for 2020 also tailed off to 3%. This was caused by lower global oil prices and stronger peso exchange. Meanwhile, BSP's projection on peso to US dollar exchange strengthened from 52.06 to 52.01 for 2019 and 51.78 to 51.50 for 2020. This was due to slower inflation in the month of May, lower GDP, decreased electricity rates, and lower prices of meat products.
Overall domestic economic activity is likely to remain firm, supported by a projected recovery in household spending and the continued implementation of the government's infrastructure spending program.
The BSP also decided to keep interest rates on the overnight reverse repurchase at 4.50%. Interest rates are also steady for overnight lending and deposit facility.
There is room for easing monetary policy because the view on inflation is quite optimistic that it's going to continue to be moderate.
Despite this, the BSP will continue to monitor emerging price stability and support economic growth. The central bank continues to monitor inflation risks, such as the weakening global economy amid easing of global demand, increasing trade tensions, and effects of El Nino. Naomi Tiburcio for The Nation.